All right, everyone. Welcome to the Sunday macro wrap up for Sunday, September 21st. My name is Johnny Zerdy. Welcome. Yeah, just like the title of the video says, the Fed basically just gave the green light to the markets saying, it's party on time. And this environment that we're in right now, it's nothing that's unfamiliar over the past 3 years because we've pretty much been going in these cycles of the Fed raises rates because of rising either growth and inflation. And this is after the stock market has already gone up a lot. They start to get a little bit more hawkish and the market sells off. And then once the market sells off, inflation and growth expectations come down, which causes the Fed to be more dovish, which then makes the stocks market go back up. And the cycle then continues, right? So all of this is pretty much the same cycle that we've been going through since 2023. And it's pretty much the same cycle that a lot of economists, including myself, like around 2023, was doubting. But yeah, I mean, we're pretty much just back in the cycle. And so from here, if we're following this no landing scenario like we've been doing, from here, we should pretty much see, which we're already kind of seeing already from the data, that growth is starting to have a little bit of a rebound, and then inflation just remains sticky. Which, when you have both stimulative, fiscal, or monetary policy, while at the same time the economy is heating up because of either growth is accelerating or inflation is accelerating or whatever, then that's typically where things get a little bit hot, and that you want to make sure that you are long risk assets. And so that's pretty much what we're seeing right now. And the featured chart that I have right here on my trading view, this is the 5-year break-even inflation rate. And the reason why I have this up for the first chart of the night here is because when you take a look at this over the past, well, pretty much since 2024, ever since when they cut rates by 50 basis points last September, you can see that, pretty much from May all the way until that September Fed meeting, you had rate cut expectations coming down, right? And this was mainly driven, similar to where it is right now, by a weakening labor market. It's almost the exact same situation as last year, but only this time is that the 5-year break-even inflation rate, which is essentially the bond market's expectation of the future inflation rate 5 years from now, that was around 1.9% when the Fed cut rates. And so, you had a weakening labor market and you had inflation expectations coming down. That's definitely a clear sign to cut. But now, an entire year later, what's different now is you have the 5-year break-even inflation rate up 50 basis points higher from the last time, and this has been accelerating since April, whereas last year it was decelerating since April, right? So inflation expectations are inching up, while at the same time you're starting to have these what our team is calling structural changes in the labor market. And if you go back a couple of videos, you can kind of view what our stance is. But in summary, and it's not just myself saying this, you can look at different economists like Jim Bianco at Bianco Research. Pretty much all the main macro people are having this view as well. And you don't need to just follow these different macro people, including ourselves. You can just take a look at the BLS data, which I know some people question it, but even just looking at the trends, even if they are wrong on the exact numbers, you can see that the actual pool of laborers is declining. And this is partly due to a combination of, well, it's mainly due to a combination of baby boomers retiring at record pace, right? I think the average age for a baby boomer is 71 years old. And so you're having a large outflow of retirees. So that takes away from the workforce. You also have record high unemployment amongst newly graduated, kids, 20 or young adults who are entering the workforce from college. That unemployment rate is at record highs, or not record highs, but extremely high levels. I think it was at like 9% or something like that. And that's a lot to do with companies pulling back on hiring. The hiring freeze is going on while at the same time they are, utilizing and using more artificial intelligence. And then the third prong of this thing is that you also have the large deportations that are going on with de-immigration. And so for the first time, I think in 50 years or something like that, you're actually seeing a negative population rate in the United States if you just look at year over year numbers. And so with that shrinking pool, of course you're going to have lower jobs numbers. And so the real question is, okay, yes, last month the jobs market only added 22,000 jobs, but is that the new normal? We have to see what happens from here if we get, more of those, moving forward. But that's the whole question now. Is this lower hiring rate the new normal with those three things happening at the same time, right? Again, if you want to go deeper into that, I highly recommend you guys do your own research as well as check out our past videos. We want to keep it on track here. And by the way, for those who are joining on our social media platforms, the way that these Sunday macro wrap-ups work is that they're an hour long, but the first 30 minutes is streamed to our audience on our social medias. And then the last 30 to 45 minutes is actually offline for our Macro Optics members who are on the Zoom call right now. And that's where we will discuss some actionable ideas, as well as answer any one of your questions. Okay, and so if you'd like to join that discussion after we close out here in the next 20 minutes or so when we go offline, if you guys want to join us there, we have a 7-day free trial of our macro investing community, which you can go and use the link in our bio there. But getting back to the subject matter here. Last week also too, we had the September FOMC. They cut by 25 basis points. It was the first time really since the pandemic where they actually included verbiage about a weakening labor market. And Jerome Powell actually acknowledged in the meeting, if you go back and watch our live stream from last Wednesday, he actually acknowledges the shrinking labor pool that we just talked about a second ago. And so what's confusing is if Jerome Powell and the Fed are recognizing this slow birth rate or population rate in the United States, they're seeing a decline, then what would lowering rates really do for that? Because lowering interest rates doesn't cause population growth. All it does is stimulate demand. And if the structural changes that are going on in the United States are mostly on the supply side, right? Supply of labor. Then yeah, I mean that's going to keep prices up no matter what. And so you're kind of you're trying to drink soup with a fork, right? Eat soup with a fork is what's really going on here with using a demand tool, which is the Fed's interest rates, to trying to solve a supply problem that's been something that is, this has been warned by economists for a long time. I thought my cat was chewing on something back there. He's a mess. He always finds rubber around the house and eats it, and I have to take him to the hospital. That cat has had 4 surgeries. Can you believe that? It's insane. And he's only 2 years old. Anyway, so I got to be on the lookout here. But that's the big issue here that's going on. All the issues that are occurring right now in the United States are just a long drawn out kind of everything converging, and economists have been warning about these for a while. So we're in a little bit of a pickle here, and that's why you see the break-even rate, the 5-year inflation rate, 50 basis points higher, even though the Fed is cutting rates. And so what does that mean? I've said this in the past. The most important chart, if I was to just look at one chart and that was it, it would be this one right here, which is the 10-year US government bond yield. And so the 10-year, not just for the United States, but in any country, this is more so the long end of the curve, which is the bond market's way of pricing in future growth and inflation expectations. Typically, when you have a rising 10-year bond yield, it's trying to price in either inflation or growth and rising, or both at the same time. And so over the past, several months here, since mid-May, you've had this have a pretty steady decline, which is, great for mortgage rates, right? Because mortgage rates more closely resemble the 10-year U.S. government bond yield, not the Fed funds rate, which is what the Fed is in control over. Despite what maybe your realtor tells you, the Fed has barely any control over mortgage rates, right? So 30-year fixed mortgage rates follow the 10-year more than anything. And so really there's only one main way to get the 10-year down, and that would lower 30-year fixed mortgages, which would be growth and inflation going down. But that usually doesn't happen rapidly unless we're in a recession, right? Now, obviously, the government and the Fed are doing everything in their power to avoid a recession, or at least one on the surface, because really for the bottom 50% of the country, they've been in recession for the past 3 years. But, for the top 10% of wealth and asset owners in the United States that make up over 50% of the consumption, that's the majority of GDP, this is what really, matters on that front with, Wall Street and them calling for or declaring a recession. The 10-year, make sure you pay attention to it. And what's interesting is that similar to what we saw last September when they cut by 50 basis points, this rose by 100 basis points after they cut rates. So it was kind of something that was a little bit of an oxymoron or unexpected, which is they cut rates, but actual rates that you and I pay for went up. Well, right when they cut rates last week, the 10-year rebounded for 3 straight days in a row. Now this thing has come down a lot, so I mean, this is still in a bearish trend. But if inflation expectations remain elevated and it still remains a problem, which I think it will be, then you won't see too much progress, or maybe slightly more progress on the 10-year bond yield unless a recession happens, which ultimately means that a lot of the lower rates that people are expecting are not going to be coming as expected, right? And, all this just puts more pressure on the markets. And, until something really crazy happens with this chart, whether it goes all the way up to 5% again or crashes down to 3%, both of which are extremes, that's really where you'll probably start to see some crazy stuff happen in equity markets with a large sell-off or whatever, right? Just like what happened at the end of March of this year or beginning of April, when you had that huge crash in the stock market briefly from the tariff tantrum, if you guys remember. Look at the 10-year. That was a huge drop over that week. And that was because there was a huge amount of recession fears, right? If the 10-year pretty much, continues treading, within its range here and kind of us experiencing and continuing this no landing scenario, then stocks have already proven that it can keep grinding higher in that scenario. And so ultimately something will end up, causing this to spike up or down. But the point is that we as investors should not try and predict when or how and what magnitude that's going to happen. Because if you do that, you're going to miss out on a lot of different opportunities and you're just going to be stuck on the sidelines, right? And that's not what you want to do, especially in this post-pandemic era where inflation is still out of control, right? A lot of people forget that inflation is cumulative, right? Even though they, on the news, show us the year-over-year rate of change rate, which is the inflation rate that you think of when it pops up in your mind, 2.8% or whatever, that's the annual rate of acceleration. That's not the actual inflation. actual inflation is cumulative, meaning that, since the pandemic, prices across the board are up, over 70% or 60% or whatever, right? That's why things still feel very expensive, even though they say that they think inflation is going to keep coming down, if that makes sense. Anyways, so stocks are still proving to work well in this environment. You still have gold performing well, near all-time highs right now. Hopefully you were taking some opportunities last week to buy the tiny gold dip. But you're also seeing some other things start to rebound, mainly, Bitcoin, even though Bitcoin looks like it might have another test lower here. But within that, you have Bitcoin miners, which have been one of the best performing assets or asset classes this year, or, since the bottom, right? Everyone talks about the 10% or 20% move since the market has been recovering, but the Bitcoin miner ETF, WGMI, which our team has been in, around like $16, $17 on this dip here. That's from the bottom, it's up 266% over the past few months. Since our team and I were gaining exposure, it's up over 150%. But when you see these types of things, as well as one of the main, asset classes that's been performing well has been small cap stocks, that you are in super risk on mode, right? And that's why I was saying in the title of this video, with the Fed basically saying like, look, we're pretty much not worrying about the inflation rate, even though in their summary of economic projections, they actually think that inflation is going to go up to 3.1% from here. Which, if you take a look at the Cleveland Fed's inflation nowcast, yeah, I mean, they have inflation for September across the board coming in at 3%. Right? So this Friday, we actually have core PCE, which is the Fed's preferred inflation gauge. Right now, it's at, 2.6%, 2.57. They have this going up to 2.99, which would be a 3 handle, which will be reported on Friday. And as you can see, this is still well above the pre-pandemic average for core PCE, nowhere near the 2% goal, right? So the issue here is that we're still continuing more so in this larger inflationary environment. But now that you're seeing some signs, not only from the real data with growth having a rebound, but I mean, you're seeing small cap stocks, a lot of things on the far end of the risk spectrum. Those things are performing the best. Last week, we saw that the core retail sales, otherwise known as the retail sales control group, had a pretty large 1-month acceleration here to levels that we really haven't seen since February of 2023. Which, this bottomed in January of 2024 and has been accelerating. But yeah, it's at 6% now. So that was a very good retail sales number, showing that, there's still demand. People are still going out and buying things. And yeah, I mean, when taking a look at the meeting, Powell referenced services inflation, how that was coming back into balance, quote unquote. But when you take a look at services inflation here, that's pretty much remained flat since March of this year. So over the past 6 months, services inflation has not been making any type of improvements. If you take a look at services minus rent, that's actually had a pretty decent rebound. Since March, that's actually up nearly 100 basis points. What about medical care services? So medical care inflation, it went from 3% to 4.2%. That's up over 100 basis points. So a lot of the main things that people pay for are up a lot over the past 6 months. Let's look at energy services. Look at that. This year, it went from 2.5% to now energy services, which are things like utility bills, gas, um, like um, like natural gas for your home, that sort of thing. That's up from, let's see, at the beginning of the year, this year is at 2.5%. Now it's at 7.8% for energy services. That's going in the opposite direction of what the Fed is hoping for. So don't let these politicians and people from Washington get on TV and tell you that. I mean, you already know that answer. I mean, you know that they're gaslighting us, but you can see it in the data as well, right? Now, this week we have a few key data points. We have flash manufacturing PMI, services PMI. We have core PCE, like we said, on Friday, which is set to accelerate. We have some home price data for our new home sales, as well as existing home sales. That'll be very important. But then also, too, what's interesting is that Jerome Powell is actually speaking at another event this week, which is on Tuesday at 12:35 p.m. Eastern Time. What we can do is, because normally I have my daily macro update videos on at 3:45 p.m., but we can actually stream it at that time on Tuesday. But yeah, that's on September 23rd. So that's at a luncheon. But yeah, Jerome Powell is set to speak on that, and that'll be a good speech to watch if he doubles down on what he's been saying, or if he starts to think about inflation a little bit more, given what's happened since they cut interest rates, which is what we just saw. The 10-year actually rising by a few basis points there. We'll see if that continues, though. Another thing that was interesting is that Trump's newest addition to the Fed board, Stephen Miran, he talks about, or he mentioned the Fed's third mandate, which is promoting a moderate long-term rate, which is what we were just talking about with the 10-year, right? So he's talking about bringing the 10-year down, which would actually get mortgage rates down and things like that. If that's the mandate, then really, like I mentioned before, all this government deficit spending that they're doing in order to prop up growth and in turn, keep inflation higher than average, they're going to have a rough time with this quote unquote third mandate of the Fed. It's like, how can you promote maximum employment, stable prices, and long-term rates when all of those are dependent on opposite things? Like, how do you have a low interest rate when you at the same time you're the market's running hot? It doesn't make sense. Nothing about the Fed makes sense. So, when taking a look at the futures target rate probabilities for the October 29th meeting, right now there's a 93% chance that they're going to cut again by 25 basis points. And so it doesn't look like the Fed is going to slow down here on their rate cutting, on rate cuts 2.0, unless you start to see inflation really start to pick up from here. So they're actually okay with running it hot over the next 2 years. But if we get into late 2026 and inflation is still higher, they're going to have a massive problem. But of course, that's a pretty long time from now in the asset ownership world. And so you just don't want to let that potential risk scare you from just being on the sidelines, right? And that's what we want to help our members do. All right. So but yeah, I mean, it's total risk on. Credit spreads are low. You have the dollar remaining in bearish trend. Lots of assets that are oppositely correlated to the dollar are enjoying that, even though, just like the 10-year bond yield, the dollar did have a decent rebound after the Fed meeting. That's, what I'm going to be paying attention to this week. Last week was a great time to sell some opportunities that are up a lot, right? I'm sure, if you're in the market and you've been participating and fading the bearishness, which is what you were supposed to do, I'm sure you've been experiencing a lot of green in the portfolio. Well, last week was a great week in order to not be greedy and take some profits so that you can have some cash in order to buy lower. And so we'll see if we get that opportunity coming up here. But, just taking a look at the S&P 500 here with the ranges for the S&P heading into the week. It closed right at the top end of the trading range there. New all-time highs. Pretty insane. Pretty crazy movement here. Pretty much straight vertical. On the day of the meeting, you did have an intraday during the meeting, little flash correction. Went right down to the top end of the lower trading range zone there before it got bought back up. So you did have an opportunity while the meeting was going on in order to buy some things. But when things are going up like this, yeah, I mean, a lot of the momentum indicators that people first learn when they start to trade, such as the stochastic RSI, a lot of these other momentum indexes, they're flashing overbought. But again, if you were just using those, you're pretty much missing out on this type of move here. And so, yeah, when looking at something like the stochastic RSI here, I mean, this thing has been, as well as other momentum indicators like classic ones, they've been slammed to the upside. So, the probabilities of a correction are higher than it, just continuing to go up here. So I wouldn't be surprised if at some point we do have a little bit of a correction in order to buy lower. But in terms of this going bearish, doesn't look like the market's going bearish anytime soon. And for those who pay attention to the video or to our live streams, the bookshelf in the background has remained green pretty much since mid-May. And yeah, I mean, the market is looking like it's going to remain bullish here until it doesn't, right? On this channel, you will never get price predictions or time frame predictions. Why? Because they're pretty much useless. No one really knows. If you listen to anybody and they're saying, "Oh, I think this can go up to this price in this amount of time frame," they're just guessing, right? The point of the markets is to stay in on bullish trends and then get out once they lose their trend. There's no point in predicting those. So that framework, by the way, has made my portfolio a lot more money than just trying to make price predictions and time frame predictions. So hopefully that message continues to be shared. But yeah, pretty much looking at the mega caps here. I mean, you had a chance to buy some Nvidia on that dip, even though it's still remaining, pretty lethargic compared to some of the other mega caps. Best one, obviously, being Google. Tesla continues its acceleration here. JP Morgan, new all-time highs. I mean, things are popping, and you just don't want to miss out on this. One of our team's preferred risk-on ratio gauges, which is the XLY versus XLP ratio. Definitely save this one. This has remained in bullish trend, and pretty much the big signal was all the way back in mid-May, right? So yeah, it doesn't look like this thing's going to be slowing down really anytime soon. Let's see here. The Treasury General account at the Fed is almost near its goal. I know by the end of September, it's trying to get to $850 billion. That's pretty much there. The RRP only has $11 billion in it, so that's nearly drained to zero. And then, yeah, you continue to have pretty decent drops in net central bank liquidity, which could be a problem later on. But we actually had new lows in bank reserves at 3.07 trillion. Well, that hasn't been this number since March of 2023. So in the background, quietly, liquidity is being drained, which could be an added headwind heading into 2026. We'll see how that works out. But yeah, I mean, pretty much the name of the game is the Fed is completely ignoring the inflation acceleration, thinking that it's something that is short-lived, and is completely scared about the slowing labor pool that's a supply problem, and they're using their demand tools to try and solve it, which makes zero sense at all. That's the update. But we're at 8:30 here now. What we're going to do is we're going to transition over to we're going to transition offline to our members only to answer questions and go over some actionable ideas. And so for those who are streaming, again, the link's in the bio if you guys want to join that with the trial link. But if not, that's okay. We'll still see you tomorrow on tomorrow's live stream. Have a great rest of your Sunday. And yeah, we'll catch you on next week's Sunday macro wrap up. For those who are on the Zoom call, stick around. Let's say bye to YouTube, Instagram, X, as well as TikTok. Bye, everyone.